A bank checking account is a good solution. It pays simple interest. But the best solution is an account with checkbook access that pays compound interest. This video will explain, and we call this solution FLS, Flex Leverage System. Your money is never at risk of loss. In the next three examples, you should pay special attention to the ROI, the return on investment generated by the initial deposit, how much money they withdraw tax-free, and what their death benefit amounts to over the years. Let's look at three FLS client examples because this will put it into perspective very quickly. In both, the client makes a one-time contribution into any of several large life insurance companies. What makes FLS unique is not the life insurance company, but the unique way leverage is created and the way the lender is paid off. Most life insurance policies that are financed, the lender is paid off in year 15 through 20. Imagine if the lender was paid off when you died, which could be 40 years from now, 50 years from now. Wouldn't that policy have an extra 20, 30 years more to compound and create wealth? The answer is yes. And that's why FLS is so much better, one of the principal reasons why. Client 1 is a successful 50-year-old business owner married to a 49-year-old wife with 2 teenage kids. All 4 were insured. He contributes $1 million one time and makes no other contributions for the rest of his life since it is financed. After the first year, over 50 years, using conservative assumptions, the client takes out 256 times more money than he put in. The details are shown on that slide. Even when they reach age 99, there's still $135 million left in the death benefit and $116 million in the account value. The second example is a 53-year-old real estate investor that was tired of what she called T&T, toilets and tenants. Once she understood that FLS actually gave her a better return than real estate did, and she no longer had to worry about the joys of fixing toilets and dealing with tenants, she could not sign up fast enough. What she did was contribute $393,000, and she pulled out 62 times more money over the next 34 years, which was $24.5 million, using, again, conservative assumptions. At age 88, her death benefit is $122 million, and the account value is $8 million. So in the previous example, it was 256 times more than the contribution in year 1. This was 62. What's the difference? One went for 50 years of compounding, the other only 34. Those 16 years make a huge difference in what you end up with. Our last example is a business owner named Victor who contributes $1.8 million into an FLS account and buys a life insurance policy on 10 employees. Their average age is 43. He covers all costs, and employees will receive 50% of the death benefit, and unlike term insurance, their beneficiaries will one day collect because this is finance, and there's a 100% probability it'll be in force. Senior Victor gets the other half. If any employee leaves, as long as the policy payments are made and it stays in force. So what does Victor get out of this? Well, the death benefit in year 1 is $88 million, year 3 $242 million. He owns half. But Victor also controls the access to the cash via loans. And these policies are tailored to achieve very specific goals. So Victor starts pulling out $200,000 a year in year 4, and by year 10 is making a 13% compound interest return on his funds, and that's with no risk of loss. By year 16, he's pulled out $11 million tax-free via policy loans, and he's projected to be earning 20% compound interest annually with no risk of loss. And the death benefit that he owns is $81 million. Do you know of a mutual fund out there that can do that? Imagine an investor earns a 12% return investing in real estate, but they have 2 options for investing. The first is the status quo direct method, where you earn 12%. The second method pays 15%, and it involves what we call financial engineering. And we explain this in our FLS chapter in our new book. But look at the benefits. You're getting the benefit of FLS plus the benefit of your investment, and you're also getting benefits 2, 3, and 4. That's a smarter way to invest, and it applies to everything, not just real estate. This table compares premium financing with FLS. The core thing to understand about FLS is your money is working for longer. The lenders get paid upon your death. So that could be another 20 or 30 years above and beyond what premium financing does. Premium financing, the lenders will lend money, but they want to get paid back somewhere between year 15 and year 20. The insurance policy has a compound return. The loan from the lender is simple interest. So you have a simple compound interest arbitrage. And if you let it go for another 20 or 30 years, you make a lot more wealth. That's the core of why FLS is better. Because that engine of creating wealth is so much better, everything else is a lot easier as well. So let's look at this right now. Row 1, client net worth. FLS, $1 million, and you can be written up. With premium financing, $5 to $10 million. Collateral. The only collateral for an FLS policy is the policy itself. Your home is not liened. Your home is liened during premium financing cases. Checkbook access. You have it with FLS. You don't have it with premium financing. Another one is you're debt neutral day one in FLS. With premium financing, you're typically underwater 10 to 12 years, and the shortest we've ever seen is 7 years. I could go on, but you get the idea. Because that engine, the compound versus simple interest engine, runs another 20 or 30 years to your death, the returns that we see with FLS are typically at least double what regular premium financing is, and that's without risk of loss and far better client terms. Thanks for watching this video. I'm Howard Francis. This is our contact information. Email works best. We look forward to hearing from you.